Hey everyone, welcome back to Upside Down Data. Today I want to talk a bit about the CPI data we got today, what it means for crypto and for the broader markets. So if you were following along this morning, you probably saw that we got a surprise to the downside. We came in at a year-over-year inflation rate or CPI rate of 7.1% and a month-over-month of just 0.1, which was below expectations. Expectations was a 0.3% increase month over month and a 7.3% increase year over year. And even when we look at core CPI, which strips out food and energy, we also saw a surprise to the downside, where core CPI was only up 0.2 month over month and 6% year over year versus the expected 0.3 and 6.1. So this has had several effects. So first off, if we just go and look at what the futures market is pricing in for the next rate hike for the Fed, it's basically pricing in an 80% probability of a 50 basis point hike in December this year, rather than a 75 basis point move, which was also possible. Now, there is still a 20% chance of that priced in here, but the expectation now of the market is that the Fed will hike by 50 basis points. Then after that, there's a lot of speculation of what they'll do. Some people might think that they might just stop there. The market tends to think that there's going to be a few more 25 basis points hikes, but really that's open question. It's probably going to be more certain based on what Powell says at the press conference after they actually make their next hike. But let's look at what the implications of that are for broader markets. So first off, we just go ahead and look at Bitcoin. Bitcoin liked that CPI print, right? We're up 3% now as I record this at 10:40 today on the 13th. But we had been up, as much from the open as high as about 5%. So a quite positive reaction from Bitcoin. And if we just also look at the total market cap, and what I've done here is I've stripped out stablecoins. So this is the total market cap minus USDT, USDC, and BUSD. We see a similar story here, up 2.6%. We were up as high as about 5% here also on total market cap, stripping out stablecoins, which aren't really the volatile assets. We don't really care so much about them in their reaction. So crypto has reacted positively, crypto being treated, as a premier risk asset, kind of a high volatility risk asset, reacted very positively, and similarly in the stock market as well. So here's the S&P 500. As I record this, it's up 1.24%, although notably it has retraced a lot of its move. If we look just from the close yesterday to the open today, it was up 2.7% at its highest. It's now giving up some of those gains. We'll see where it ends up sitting after this. Now you'll notice I have this trend line drawn here. This is one I've had here for a while. And basically it's just kind of the peaks that we've been going down this entire bear market. And you can note that we're kind of bouncing off it. We had broken above it, we're now going below it. So, playing around that area. And obviously, it's questionable how much these trend lines matter, but it is just notable to watch this, because if we decisively broke above it, that would be something that would be interesting to be able to kind of break out of this downtrend we've been in for so long. Doesn't necessarily mean that we're out of the bear market or anything like that, but it would just be something that would be different from what we've been doing in the past. NASDAQ also reacted pretty positively. Similar kind of, didn't get quite up to its previous trend line, but reacted positively. But again, trading down on the day from that initial surge at the open. And the Dow Jones has also, it's already broken out of its kind of downtrend it had been in, but it's, trying to break up above this, but now, giving up the gains as well. But regardless of all that, generally a positive response from risk assets across the board on this. Now, the one thing I want to talk about, though, going off of this is that you might say, okay, favorable CPI data might mean that the Fed's going to be more kind of dovish or less aggressive in the future, maybe not hike as high as people originally thought, or as fast at the very least as people originally thought. Does that just mean green light for risk assets, bull market back on, off to all-time highs? Well, maybe, but maybe not. And so this is something I talked about before, but I want to talk about it again because I think it's really important to know about this and have this in mind. Let's go and look in the past at times during previous Fed rate hiking cycles of what happened when they actually did pivot, when they actually did pause and then ultimately reversed course. What happened in the stock market? So we're looking at the S&P 500 here. That's what the bars here. And what I have here in this orange line is the Fed funds rate. So basically, whatever the Fed funds rate is, that's what this is looking at here. How high has the Fed hiked rates. And let's just see what happens when the Fed pivots. So let's go all the way back here to 69 into the 70s, kind of into that first big, or that kind of analog that people have been looking at as that big inflationary period in the dollar, that stagflation period, which a lot of people have been comparing what we might, what some people are expecting us to go into, over the next several years to decade. So let's look at this, 69 into 70. You notice that the Fed started hiking rates. They kind of more or less paused up here, and then they cut right here. Look what happened to the stock market here. The stock market continued down when the Fed paused, and then actually didn't end up bottoming until after the pivot, until after the Fed cut interest rates. So even when the Fed did what the market is screaming for the Fed to do now, what a lot of people are saying is the bullish scenario, the Fed cutting interest rates, that actually didn't stop the bleeding in the market, and actually we found our bottom quite a bit after that. And if we just look at kind of a measured move here from that point down to the actual bottom, it was another about 24% move to the downside after the Fed cut interest rates. Same story over here in 74. Look, the Fed pivoted. They actually just hiked and then cut immediately. The bottom didn't find, the market didn't find a bottom until after that, right? Until a few months after that's when we actually found the bottom in the market. Same thing over here. The Fed cut, raised, cut, but after this cut, we didn't find our bottom until, several months later. Actually, even longer. This was in July of 81. We didn't find it until almost a year later that we found the bottom after the Fed had started to cut interest rates. And then if we go back to the more recent kind of big recessions that we've had and big stock market crashes that we've had, 2000 into, the bear market that lasted into 22, look at this. The Fed paused right around here, the top, and they started cutting interest rates. But after they started cutting interest rates, look how much further the market fell before we found a bottom. Same in 2018. The Fed pivoted, started cutting here, and then, look out below, that's where we ended up going. Same thing even here with the March 2020 crash. We pivoted, ended up seeing a big crash, and then we've now gone up. So if we're just going to think about what might happen at this next Fed pivot or pause that we're going to see, is it the case that we're just going to go back into a bull market? Well, history would say maybe not. Historically speaking, when we have these rate hiking cycles and then the Fed ultimately pivots, oftentimes you actually see more downside in the stock market. And the reason for why back in these times is that these rate hiking cycles, maybe not being the sole thing, but they certainly contributed into slowdowns in the economy, which led to recessions. Now, obviously, with some of these, you had things like the housing market blowing up, which is an additional catalyst. But basically, the Fed was trying to slow down the economy during these these hiking cycles, and then that oftentimes leads into recessions that can either be relatively mild or relatively severe. But either way, it generally leads to more downside in the market. So if we're just looking at what's going on right now, I'm not going to be so sure if we see a pause and then, ultimately a cut, if that means that the worst is in for the stock market. Because historically speaking, that has not often been the case. Sometimes it is, right? Sometimes you'll get the Fed cutting rates and the market's able to continue going up, but oftentimes not. And so really, if we think that a recession might be coming, and there's different reasons to think that that could be happening with yield curve inversions and things like that, I would actually not necessarily see it as a bullish sign of the Fed pausing or pivoting, and that the market could have further downside to go from there. So just something to keep in mind. If we do see a rally from here, a continued rally, let's say the market kind of picks up and we end up seeing more upside in the different stock market indices, it's not a guarantee that means that the bear market is over and that these lows back here in October are the lows. We might actually see more downside if we go into a recession. And so really, to be bullish on the stock market, you have to be betting on both that peak inflation's in and that the Fed is going to actually pause and or pivot soon. And you also have to bet on us getting a soft landing where the Fed didn't cause a recession. If both those things come true, then it could be that this is the bottom, potentially. But if you don't, if you're wrong, and let's say you're right that peak inflation has happened, but you're wrong that a recession will be avoided, we could see further downside possibly here. And so to end us off, what I want to talk about is why I think right now is a really interesting time to be looking at bonds relative to something like the stock market or even crypto, which has, acted more like a risk asset. I would expect it to act more like the stock market, kind of follow what the stock market does more than other potential assets. Now, I know bonds are boring and, some people probably don't really care too much about them, but I just still think it's interesting to talk about them because when we were looking at our current situation, there's some interesting things to talk about here. So with bonds, they've been getting destroyed recently. So I'm showing you right now is the TLT ETF. It's an ETF that's basically 20-year U.S. Treasury bonds and further out, so kind of long duration treasuries. And, in 2022, bonds got absolutely destroyed. Look at this absolute catastrophe in the bond market. This is the most brutal drawdown that TLT has ever seen, right? It's never seen a drawdown this severe in its existence. But what's notable is that this is kind of an exception. It's an exception to the rule that bonds get destroyed at the same time that risk assets are, that stocks are. If you look back at previous kind of big collapses in the stock market, so here's the 2007 into 2009 kind of crash in the stock market. Look what the TLT did back here. It went parabolic to the upside while the stock market was going parabolic to the downside. And you can see that generally there was kind of this inverse correlation, especially in these extreme moments, these extreme recessionary moments. And you can see it also here in March 2020, this big crash in stocks, this big surge in bonds. So this inverse correlation, you can see this also in the IEF ETF, which is the 7 to 10 year treasury bonds. Same kind of story into the 2008 crash, stocks collapsing, the IEF surging. Same thing here going into the March 2020 crash. And if you look at the SHY, which is an ETF that's shorter term duration, 1 to 3 years, same kind of story overall. And then, of course, getting killed in this more recent year. And we can also just see this further back in time if we do, basically what I've taken here is the 10-year treasury yield. And I've just basically inverted it. So generally speaking, the yield of a bond is inversely related to its price. So the higher that the bond will yield, the cheaper the bond is. So if you're seeing yields go up, it means that there's actually a lot of selling of that type of bond. What I've basically done is just flip it around so that higher values here mean that 10-year treasuries are doing better, lower values mean 10-year treasuries are doing worse, just so we can kind of get that similar picture of an inverse correlation. And here we can actually go back further in time. So let's look, for example, at the 2000 stock market crash. So the orange line here again is the S&P 500. It crashed here, like we've talked about many times in the past. 10-year treasury yields or 10-year treasuries ended up doing very well. So this is yields went down, but then that means that bonds were bought. So in this kind of inversion I've done, 100 minus the yield, we can see the 10-year treasuries did very well while the stock market was doing terribly. And then like we just talked about with the IEF, doing really well while the stock market crashed in 2008. And so when we're thinking about bonds and what might be bullish catalysts for bonds, one of the reasons that bonds got destroyed here was the expectation of the Fed getting really hawkish and that interest rates would go up and therefore better yields would be on the horizon. And therefore, why would you hold bonds that are yielding really low interest rates back here when you could sell then buy back in when they were yielding way higher interest rates after the Fed was done with its rate hiking cycle? And so really, bonds have been destroyed in no small part due to Fed policy and other central banks. Although for U.S. Treasuries it'd be the Fed really tightening monetary conditions, raising interest rates. But now that might be coming to an end, right? Now that might be coming closer to a close, bonds look a lot more attractive because if it's the case that the Fed is kind of nearing the end of its rate hiking cycle, then suddenly this is looking more and more like these might be the best bond yields we're going to get. And so then more money might flow into that space. And what's notable about this inverse correlation between bonds and stocks in these recessions, in these crashing periods, is that a long bet on bonds, a bet of bonds doing well over the next several years, for example, all that you're really betting on is that the Fed, that inflation has peaked and that the Fed is kind of near its terminal rate on its rate hiking cycle, that we're not going to go much higher on interest rates, or that the Fed's not going to move its Fed funds rate much higher. You're not betting against a recession happening, right? You're not having to say that a recession, won't happen for bonds to do well. Because we've seen in the past that generally speaking, when we get these recessions or these crashes in the stock market, that's actually super bullish for bonds. It tends to be where people flee to. They sell out of risk assets, they move into treasuries. It's the safe haven. And so really a bet on bonds right now is saying that inflation's peaked, but you're kind of agnostic to whether or not a recession happens or not. Because really, essentially, if the Fed pauses here or then slowly starts to cut interest rates and we don't actually get a recession, bonds aren't going to care that much. You know, we might not get the surge that we've gotten, you know, in these recessionary periods, but if the Fed is either pausing or lowering interest rates, then bonds are probably going to do just fine. The thing causing them to move down is gone. And so you're betting on one fewer things happening to be long on bonds here than you are on betting on treasuries or risk assets being here. Because again, risk assets, equities, at least in my opinion, you know, none of this is financial advice, of course, you make your own opinions, but in my opinion, a long bet on equities right now is betting that both peak inflation's in, so that we'll get a more dovish Fed, and that we won't get a serious recession that causes earnings to fall off a cliff, et cetera, unemployment to skyrocket, all of those kinds of things. Whereas a long bet on bonds right now is merely betting on interest rates having peaked, and less so about a recession, because again, if bonds act as that safe haven again in a recession, they'd actually do quite well in that environment. And we just know probabilistically, the probability of one event happening is more likely than the combination of two events. You know, the likelihood of peak inflation is more likely than peak inflation and soft landing and no recession. So just something to keep in mind. So I'm kind of very interested in bonds right now. I'm watching them quite closely because, you know, if this ends up being peak inflation, they might be something that's actually offering a decent risk reward relative to something like equities, where you'd have to kind of fade a recession happening to be able to win out on a long bet on that asset right now. So again, none of this is financial advice, but that's just what I'm looking at. And so to kind of sum it up, short-term risk assets are really liking the CPI print, but kind of what we've seen before with Fed funds and what's going on with rate hiking cycles, be a little bit careful. A pause and a pivot is not a guarantee that the market has bottomed. And in fact, history would suggest that it rarely has at that point. But bonds are something that's different, and bonds are telling an interesting story. And it's possible that this absolute bloodbath we've seen in bonds is nearing its end, and that they might be actually offering a decent risk reward, assuming they go back to that status as being the safe haven asset. Now, some people have been arguing that that is now no longer the case, and that bonds are seen as worthless around the world. I don't know. I think it's probably too early to say that that is happening. I think that bonds are an interesting thing to watch, something that I'm going to be looking at right now. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, better indicators, and more over there.